Chapter 2, Analyzing Transactions. So accounting systems are primarily there to show increases and decreases in each element of the accounting equation, whether it's an asset, a liability, a stockholder's equity, a revenue, expense, or dividends. Each of these records is called an account. If you recall from Chapter 1, these are the transactions for November for the new startup called NetSolutions. So they have three assets: cash, supplies, and land. They have one liability account, accounts payable. They have, at the beginning of the month, one stockholder's equity account, common stock, and then they have fees earned, which is their revenue accounts, and then 5 expense accounts: wages, rent, supplies, utilities, and miscellaneous. Now, for purposes of instruction, we use what is known as a T account. So a T has a left side and a right side, and then a title of the account, whether it's cash, accounts receivable, fees earned, or wage expense. The left side is called debit, and the right side is a credit. So debits and credits. So debits left, right, credit. So here are the transactions in a T account from November for NetSolutions. We started the month with transaction A, which, if you recall, was the shareholder depositing $25,000 into a bank account in the name of NetSolutions in exchange for all of the common stock. And then B, the purchase of land for $20,000, which is a reduction in cash. So for assets, what debits do, the debit side of the account records all increases. And there were 2 in November: the $25,000 initial deposit, and then $25,000 collected from customers in transaction D. The credit side is the purchase of the land, a $36.50, which was wages as well as miscellaneous. $9.50 was a payment, partial payment on the accounts payable, and the E transaction was wages, automotive, and miscellaneous, 3 expense accounts. And then H, which was the payment of the dividends. All right. A group of accounts is called a ledger, and they're listed in numerical order in what is known as a chart of account. And they are listed assets first, which are typically numbered starting with a 1, liabilities numbered starting with a 2, stockholders equity are 3, revenues are 4, expenses are 5. So these are all the assets that a business entity may own. Here's types of accounts, including unearned revenues, which are deposits from customers for services or merchandise that has not yet been delivered. And then stockholders' equity, for purposes of this class, are going to be common stock and retained earnings. Now, dividends are a distribution of earnings to stockholders' equity, so they are typically numbered in the stockholders' equity section, but they're a retained earnings subset, just like revenue and expenses are. So revenues can be fees earned, fares earned in the case of a taxi or a bus, commission revenue for real estate brokers, or rent for landlords. Expenses, we've seen wages, rent, and utilities, and the supplies and miscellaneous. These are the same 5 expenses that NetSolutions all incurred in November. So as I said, assets begin with a 1, liabilities 2, so forth and so on. So a chart of account for NetSolutions may look like this. So cash, which is account number 11, down to office equipment, number 18, liabilities 21, unearned rent 23, and then common stock, retained earnings, and dividends are 31, 32, and 33. The expenses are 41, and then 51 through 59, or the expenses. 41 is the revenue account. So what we use in the United States, and we use really all over the world, is what is known as the double entry accounting system. It is a 700-year-old system. Merchants in Venice originally started using this. There are historical records dating back to the 1300s of merchants conducting their accounting system in this manner. And so every business transaction is going to be recorded in a minimum of 2 accounts. There can be some transactions that will have 3 accounts or 4 accounts or hundreds of accounts, but they will all have at least 2. There'll be at least 1 debit and 1 credit for every transaction. So the debits increase assets and decrease credits. So debits increase asset, credits decrease. For the accounting equation to work, the opposite has to occur on the right side of the equation. So debits decrease liabilities and credits increase them. So primarily what you need to remember is the debit increases assets. From there you can work out all the rest of it. So compared to an asset, debits are the increase, which makes credit the decrease. The opposite has to occur for liabilities, stockholders' equity, revenues, and expenses. So income statement accounts all increase or decrease a stockholders' equity account. So a revenue account decreases with a debit and increases with a credit, just like common stock does. The expense accounts act sort of like assets, but what they are, they're negative revenues, negative retained earnings. So a debit will increase an expense account and a credit will decrease. The same with a dividend account. Dividends are similar to expenses in that debits increase them because dividends decrease retained earnings, which is decreases stockholders' equity. So rules, as you can see, here is the slide that if you want to print it out and tape it to your bathroom window, bathroom mirror, this is what you need to remember for this Principles of Accounting course. So, but as I indicated before, if you understand this part here, debits increase, credits decrease assets, then you can work out all the rest of this. You don't need to memorize it. You just need to focus on what a debit does for assets. As we record transactions, we analyze them, we record them in what is known as a journal. And a journal is chronological in nature. So we record them as transactions occur. So in the far left column is a date where we record the date of the transaction. We then record the account that is going to be debited to correctly categorize and record this business transaction. And we indent the credit. So the debit will be left justified, the credit will be indented just slightly. Then a brief description describing the transaction, and a posting reference to refer to where what page in the journal, in the ledger, account ledger, this transaction will get recorded in. So journalizing business transactions is done in a 2-column journal, and we're going to show examples of that over the next few slides. So going back to November transactions, Chris Clark opened up a bank account in the name of NetSolutions in exchange for all the common stock. So we recorded that in Chapter 1 by a plus under the cash column and a plus under the stockholders' common stock column. Well, in a journal, it would be 2013 at the top of the page, November 1, a debit, you see it's left justified, cash, a small indentation for common stock. The description is issued common stock for cash, and then we put the $25,000 in the debit and credit column. Those are then posted to the T account for cash. So on the left side, the debit, which increases the cash, and then on the right side, the credit increases common stock. We then bought the land. That's a debit to land and a credit to cash. We bought supplies on account. That's a debit to supplies and a credit to accounts payable. Credit increasing liabilities. We then received the $7,500 in exchange for services provided to customers. So that's an increase in revenue, which increases net income, increasing retained earnings, which is a stockholders' equity account. Then we paid our wages, rent, and utilities, as well as miscellaneous. Those were the four. And that totaled the $3,600 decrease to cash, increasing each of those 4 expense accounts. Then we made our partial payment to the creditors for the supplies that we bought on account. Then we went through and counted up the remaining supplies that were on hand at the end of the month, determined there were $550 left, giving us $800 worth of supplies that were used during the month. And then lastly, we paid the dividends. So that's an increase to the dividend account, which is a negative stockholders' equity account. Once you record the journals, then you post it to the T accounts, and that is called posting. So here on December 1, we paid for a 1-year policy. That is an asset. A prepaid insurance, that's a prepaid expense, and a decrease to cash. So posting that, where you take that $2,400, we put it in the prepaid account number 15, another asset account, and we debit $2,400, and then we credit the cash. So in the ledgers, which the ledgers will have a 4-column page, and there will be a ledger for each and every account in the chart of accounts. So there'll be a cash ledger, a accounts receivable ledger, a supplies ledger, a land ledger, a prepaid expense ledger, every one of those. And what the last 2 columns are is a running total, just like your checking account. So here's the journal where we paid for the 1-year policy, insurance policy, and you can see we put that down into prepaid, into the debit column, and then over in the right 2 columns we total that up to $2,400. Down in the cash account, we had, before the December, at the end of November, $5,900 in cash. We then wrote the check for $2,400 for the insurance policy, bringing our account balance down to $3,500. We paid for the rent in December. We get an offer from a local retailer to rent the land that we bought back in November, and they're going to give us 3 months rent in advance. So that's a liability to us until such time that this local retailer uses the parking lot for its employees and customers. It is in the tune of $120 per month. It's not revenue yet. It's a liability until such time. So here is the accounting equation to the T accounts. Then we buy some office equipment on account. We buy some advertising in a local newspaper, and we don't have an advertising expense, so we take all of that to miscellaneous. Paid our wages once again. We pay creditors, and then we pay our receptionist and a part-time assistant for 2 weeks worth of work. Then we receive some additional revenue in the form of a cash receipt from our customers. Okay, fees earned on account is an accounts receivable. It's a customer that we invoice and they promise to pay us in the future. So if we get $1,750 in invoices that we send out in the middle of December to our customers that we did work for, that is an accounts receivable. And we pay down some of the debt on the office equipment that we bought. We received another payment from the invoices that we sent out on December 14th. We bought some more supplies. This time, rather than buying them on account, we paid cash for them. Another 2 weeks of wages. Paid utilities, the phone bill, the electric bill, and then we invoiced and received in cash some additional revenue from customers. We then billed out the second half of the month services provided to customers that have not yet paid us yet, increasing the accounts receivable balance, and then we paid our dividends. So the various account ledgers at the end of December, you'll see the cash account with its running total. The accounts receivable account had that initial billing in the middle of December, a partial payment on the 21st from one of the customers, and then a subsequent billing at the end of the month. We had the initial purchase of supplies on account that we used up 800 of it in November. We then bought another $1,450, and we haven't yet counted the supplies remaining at the end of December. There's our prepaid insurance, our land, office equipment, the 2 liability account now, accounts payable and unearned rent, the 2 dividend stockholders equity account, common stock and dividends, the fees earned, and then the 5 expenses. So if we take the balance of all of these accounts and list out all of the debits and credits, that is a trial balance. And here is the trial balance at the end of December for all of the accounts ledgers and their respective month-end balances. All right, that's it for Chapter 2. I'll do a series of problems and post those next.